Okay, so good morning, everyone, and welcome to today's macro snapshot. We'll keep it quite quick, quite short. It is Friday, June the 7th, 2024. First thing I'd just say, guys, is that if you look at some of the markets here, everything's pretty much trading in a range. We saw that yesterday. This is the cash equities SPX on the daily chart. You can see that yesterday not a huge amount of price action, and if we look overnight on the ES, it still hasn't moved too much. So why is that? Obviously, everybody's waiting for the important data points today. So let's immediately look at the non-farm payrolls and just see what numbers are expected. I mean, I think the thing is that we had a weakish ADP. So if we go back a little bit, we had go back to the beginning of the week. We can see if we go back to Monday the 3rd, we had at the beginning of the week, we had the ISM manufacturing, and you can see here the employment there was actually relatively good. So that was still in expansionary territory, 51.1. So that was good. But if we look at some other labor market sort of readings from the earlier this week, we see that the JOLTS number was significantly lower than expected. The quits rate was lower. Then if we look at the ADP, which is a private payroll survey, that was about 20,000 jobs less than expected. Again, to repeat, not super correlated to ADP, but nonetheless, sorry, to non-farm payrolls, but nonetheless, that is something to keep an eye on. The other thing is, in terms of recent data, we had ISM services, and if you look at the employment there, that was below 50, but pretty much steady, and actually a little bit more than last time. So what to make all of this? I would say that the data seems to be saying that the labor market is solid. Oh, initial jobless claims as well. Initial jobless claims yesterday was a little bit higher than expected. I think 229,000. Where is that? Do we have it here? Yeah, initial jobless claims, 229,000. So ticking up just a tiny bit. But if you look at the 4-week average there, still very low, 215, 220,000, which is very, very far away from a recession. Nonetheless, there do seem to be certain signs that the labor market is possibly slowing just a little bit. I would say it's robust, but slowing very, very slowly. Now, the Fed's going to like that, because remember, the Fed has 2 employment mandates. At this point, the employment market is strong, so they are still focused, number one, on inflation. So again, let's look at the numbers for today. Where are we? Okay, so if we just start to look, actually, what I'm going to do, I'll put this on a different page. It'll be easier to look at. Just give me a second. Sorry, give me a second here, guys. So put in Echo US, and yeah. Okay, so first of all, let's look at the numbers. What I'm trying to suggest here is that if the numbers are, I think there's more concern about a slowing down. If the numbers are strongish, expected 180, if the expected 190, if it comes in at 190 or 200,000, will the market be super excited? I don't think so. I think really where the market is trying to figure out at the moment, just at the moment, is, are we seeing the beginnings of cracks in the US economy? Are we seeing the beginnings of weakness in the US labor market? So I think the markets has almost an asymmetrical focus on the downside. So if we look at, let's say, like a standard deviation here, as I say, the consensus is for 180, so 180,000. But the high estimate, as you see, goes up to almost 260, and the low estimate 120. So you can see here the range is about, what's that, 140,000 or so, but with the consensus at 180. But if we look at the standard deviation, let's call it, well, about 20,000, 25,000. Let's call it 20,000 just while we're here. So the thing is that, if it's 1 or 2 standard deviations, so let's say 2 standard deviations would be 220, 230,000. I don't think the market will, draw the conclusion that, oh, necessarily that means the Fed will hike or anything like that. It could just mean that the Fed will be in no hurry to cut. So at the margin, I think that will, maybe, get the bonds to sell off a little bit at the front end, something like that, or maybe even more at the back end. But we'll talk about that in a second. Now, let's say, for example, we get 1 or 2 standard deviations below consensus, which would be, 160, 140, 125, something like that. I think then the market would start saying, does this really mean, that would sort of support the idea that the labor market possibly is starting to slow down? The implication there would be that a sort of inflation could have less upside pressure. And at that point, I think you'd have to start looking at sort of, some of the what's priced in for the Fed. Now, what's happened is that over the last couple of weeks, we've now priced in, a slightly more dovish Fed. And you can see here, if we're looking at the US, that, by the end of the year, we now have 48 basis points priced in, which equates to 2 cuts. So as you can see here, 1.9 cuts priced in. So basically what the market is saying is that at some point, now at this point is saying that probably September, about 20 basis points, there'll be the first cut, and then the second cut will be in December. So 2 cuts, okay. So the question is, will the market on a dovish number start to price in the possibility of a third cut for this year? Possibly a few basis points. But personally, what I'll be looking for, I was reading a lot of commentary over the last day or two. Some people are saying just because of the sensitive political sort of situation, and of course we do have an election in the first week of November, possibly the Fed, because it does not want to be seen to be intervening in the US electoral process and favoring any party, especially Biden, rather than going with a first cut in September, which is pretty close to the election in November, will it instead opt for a July cut? June, of course, is very soon. It's premature. It's next Wednesday, but maybe July. And what's interesting to me is that if you look at July, only 21% a chance of a cut, or 5 basis points. Could it be that if we start to get some weakish real economy data, starting with today, that this number of 5 basis points starts to go up to, 10, 11, 12. Maybe even that's going to be priced for at least a 50% chance, which would imply this number goes up to 12 or 13. And maybe less in the September. So a little bit of pricing coming out of September and being transferred to July. That's something which I'm personally quite interested in looking at. Anyway, so that's so keep in mind standard deviation 23,000 on that. And obviously the algos will move more aggressively on the number of different number of standard deviations from the consensus of 180. If we look at some of the other numbers, I'm not too interested in private payrolls and manufacturing. We've already got that. The employment rate, which is the household survey. So keep in mind that the change in non-farm payrolls is the establishment survey. It doesn't include households. It doesn't include sort of agricultural businesses. And that's interesting because a lot of undocumented workers apparently in the US are sort of working, and that won't show up in that headline number there. By the way, just talking about the headline number, always net revisions, very important to see the revisions, see if last time that number of 175 is revised up or downwards. What's going to be important looking at the household survey is the unemployment rate. The Fed has signaled that it's okay if that goes up to 4.1. They regard that as a price which they're prepared to pay. Maybe not too much higher. Keep in mind Powell's remarks recently that he said that if the economy, if the labor market were to weaken too much, they would sort of asymmetrically be prepared to cut. He didn't say it in such a clear way, but that was kind of the implication. So the point is that if the unemployment rate ticks up to 4%, okay, not that's probably acceptable, but anything north of 4%, we start getting to 4.1, 4.2, 4.3. I think the market would interpret that as being, a justification or for Powell to potentially cut, as long as inflation is not going too crazy. Anyway, so that's definitely something interesting to look at. And then, of course, an important one, labor force participation rate. If that goes up, that in theory means more people are entering the pool of available and active workers, which in a certain sense is disinflationary. Always interesting to look at that one. Then, of course, the average hourly earnings. What was interesting is that yesterday we did get the unit labor costs, the second and the final reading for last quarter, revised significantly. The first reading was 4.9%. Yesterday, that figure was revised down to 4%, which was pretty dovish, and there was a kick up in the bonds on that data. So the point is that the average hourly earnings, I'd be curious, that may actually come in a little bit lower than expected, just because we did see, as I said, that downward revision to the unit labor costs yesterday. So is that a sign that labor costs are cooling in the US? Wages are cooling in the US. Interesting. We got data overnight from Europe basically saying that wages were going up a little bit. So a bit of a discrepancy here. So anyway, let's have a look here at the average hourly earnings. 0.3 is the median, as you guys can see here. There is a range between 0.4 and 0.2. So of course, 0.4 would be on the hot side, 0.2 on the lower side. I mean, it's interesting to me because if you think about what happened, we had the Bank of Canada cutting, I would say in a neutral way, a neutral cut on Wednesday, a couple of days ago, and then of course yesterday we had what we could only describe as a relatively hawkish cut by the ECB. And keep in mind, this is the first time that the ECB has actually cut before the Fed, going all the way back to 1999. So what I'm trying to say in terms of the Fed possibly cutting in July, could what the ECB what they did yesterday, could that be used as a template, which is to say a cut, but refusing to outline the future path of any other potential cuts, and saying they're data dependent, sort of. So a data dependent, relatively hawkish cut, which refuses to pre-commit, as Lagarde said yesterday, to a future path of cuts. Maybe the Fed wants to do that, or could do that in July, and just say, hey, we don't want to be too late in the curve, but we don't want to, but we still remain data dependent. And the implicit understanding is also they want to let the political process play out in autumn, like in September and October, and maybe they could do a second cut, potentially November, or even, one in November and December. Anyway, just interesting. That's definitely what I'll be looking at. At the same time, those of you who follow CAD, quite interesting as well, because we have Canadian unemployment or employment data coming out at the same time this morning. What's expected is 22,000. Again, I don't know if we have the, let's see if we have the data. Yes, so the range for that, kind of interesting. We have a high of 96,000 and a low of -5, so about $100,000 dispersion. But keep in mind the number of estimates here is only 14, so I don't know if this is a good sample size. But nonetheless, standard deviation there is actually bigger than the Fed, 24,000. Or sorry, than the US at 24,000. So keep an eye on this number. Let me just go back here. But again, as always in Canada, the part-time and full-time, very important, that sort of mix, and the unemployment rate, 6.2. So this is one of the reasons that the Bank of Canada cut, just because the unemployment rate does seem to be ticking up in Canada. Now that's going to be interesting, just in terms of let's say the Canadian dollar. So let's just have a quick look and see what's going on with the Canadian dollar here. Let's have a look. Where are we? So I'll put it USD CAD. As you guys can see, more or less in a range. I mean, you could say there's some sort of bull flag in favor of the US. You could argue it's a bit of a sideways choppy range, or slightly flagging formation. But the point is that if we get, for example, a strong number in the US and let's say a weak number in Canada, that could be the green light for the US dollar to break out of this range up to the 138.7 level up here. Conversely, if we get an opposite, we get a relatively strong data in Canada and a lower than expected number in the US, of course, that could cause a sort of a sell-off here. So that's going to be quite interesting. Personally, I'll be looking at some of the cross pairs as well. CAD's been trading a little bit heavy. Let's say, for example, you look at Euro CAD. You can see that the euro has been doing pretty well. So the next direction there could be determined by the Canadian data as well. So keep an eye on all the cross pairs. Getting back to the main stuff, what I would first of all, I'm going to look at gold. We had news overnight about 4 a.m. You see a big on the daily chart here. You see a big red candle. There was news that the People's Bank of China, which had been a large and consistent and persistent buyer of gold, apparently they halted or severely reduced their gold buyings. The data just came out. The idea was that as gold hit a new time high, they decided to hit the pause button. So the gold market and the metals market in general not liking the idea that the People's Bank of China has pulled away from buying. So I would say that if we get a soft number today, there's a chance for gold to really maybe retest down to some of these key fib levels and horizontal support levels, 2290, for example. We also saw that silver was hit on that news. Pretty big red candle here on silver. Again, just you draw your fibs from either, let's say something like the 2nd of May, or maybe this impulse 27th of February, just be drawing your fib lines, your fib retracements. This level here for me remains a point of interest because it's the crossover of two fib levels. Sort of a shorter term and a longer term fib around about, what have I got here, about 28.80, $29, something like that. I think would be an interesting level there. Also in the industrial metals space, we see that copper also had a sell-off, but copper getting to quite an quite an attractive, at least from a risk reward point of view here. You can see that something around about 44.44 would be an interesting risk reward, or what would be a tremendous price would be even lower, around about 4.25 there. So keep an eye on the metals. In terms of the bonds, we saw initially yesterday, if we go, I'll just go on the 10-year yield in Germany, we saw that on the cut, yields actually went up a little bit because that cut was, 85% priced in, fully expected. And the fact that Lagarde was, fairly hawkish in the communication and refused to sort of guarantee further cuts, that pushed up the yields here. So the yields going up there over in the German space. But if we look at the US, which, where are the US yields? A bit further down here. Yeah. So let's just have a look and see, let's say at the front end of the curve here. We can now, what I'd say, guys, is that the US yields have come down a lot. They're at a pretty critical level. If you look at the 2-year here, down at 4.72. Again, if we get a soft number, can these come down more? Possibly a little bit. But the point is that we have 2 cuts priced in for this year. Really, on one number, will the market price in more cuts? Possibly, but I think it's more going to be that the Fed might price in earlier cuts. So I don't know how much downside to yields there is. I mean, if we get a super weak number, let's say, 80,000 with an unemployment rate at 4.1 with average hourly earnings 0.2, 0.1. For sure, this could come down. But I think there's more asymmetry for just the market to sort of reprice a little hawkishly, because I personally think that until we get rid of the CPI next Wednesday and we get through the Fed meeting next Wednesday, which is obviously, extremely important, I think the market is possibly more comfortable trading within this kind of 25 basis point range, which is not to say can't poke down here. But I think, as I said, there's maybe more asymmetry for an upside, like in the yields, which would be a hawkish number. Again, if we look at, let's say, something like the 10-year, I also want to show you guys, as I think I said yesterday, if you look at the moving averages, that's pretty critical. We have the 200-day moving average in the 10 and also in the 30s. So as I say, I think the market will be more comfortable heading upwards in yields. We'll have to see, have a look at that. In terms of the equities seem ready from a technical perspective. I don't see anything to stop the equities from a technical perspective from going higher. I mean, as I've pointed out a few times, we have, Fibonacci retracements, we have Fibonacci extensions. It's sort of at the highs. Could it extend higher on like a Goldilocks number? So what would a Goldilocks number be? It could be something like average hourly earnings stable, or maybe even down a tenth. It could be on a number which is not too hot and not too cold for the headline. So something around about, 140, 150, 160, 170. I think the market would say, great, maybe unemployment rate, which is stable. I think on that kind of Goldilocks, kind of not too hot, not too cold number, the equities could definitely push up. That's that. But apart from that, other things to keep in mind, we do have a lot of bond issuance next week. We have the 10s and the 30s, and I think also maybe the 3s, but definitely the 10s and the 30s bond auctions next week with very high numbers in the issuance. And all of that is happening, of course, as we have the CPI on Wednesday and the Fed on Wednesday. So significant dangers ahead, especially for the bond market, but also potentially for the equity market. If we have a higher than expected CPI, maybe a relatively hawkish Fed, or a Fed which is signaling still that they're not ready to cut. And if we have hot numbers today, who knows? Maybe the equity market will take a breather here at these highs and sort of drift down a little bit. We shall see. All will be revealed at 8:30 and then next week. I'm going to leave it there, guys, just so we all have plenty of time to prepare. So take care, and we'll keep on talking. Thank you, and have a great weekend.